Thank you very much, and good morning to the very first panel of today about regulatory architecture. The G20 Comprehensive Financial Sector Reform Program was put in place after the financial crisis to build a safer and more resilient global financial system. With this also came some changes to the supervisory architecture. As we work towards completing the implementation of remaining post-crisis reforms, it is important to review whether the reforms had any unintended consequences and whether the supporting institutional architecture is functional. In April last year, the Financial Stability Institute developed a short paper reviewing changes to the financial supervisory architecture since the crisis. The FSI paper reflects on elements of central bank involvement in financial supervisory architecture, highlighting areas of synergy and potential conflicts of interest. The synergies identified stem from the links between financial and macroeconomic stability and from the connection between monitoring the overall liquidity of the system, that is the role of central banks, and the oversight of the financial system solvency, that is the role of the prudential supervisory function. In other words, conflicts may emerge on monetary policy decisions concerning the setting of interest rates can impact banks' profitability and solvency. The paper also flags how the assignment of prudential responsibilities to the central bank could raise concerns of a political economy nature, including reputational risks and perceptions of excessive concentration of authority. Different jurisdictions have assigned financial sector responsibilities to various authorities using various models. Some jurisdictions have implemented incremental changes in existing supervisory models, whilst others have gone further by changing their supervisory models. Firstly, the sectoral model is still the most commonly used organizational arrangement. It is employed in about half of the 82 jurisdictions covered by the FSI survey conducted between February and September 2017. The integrated model, sometimes referred to as the single regulator model, is applied in 1/3 of the jurisdictions. And thirdly, partially integrated models, including the Twin Peaks and two agency models, have been adopted in 1/5 of the jurisdictions. It's thus useful to reflect on how well the models have worked across jurisdictions and whether adjustments needed along the way and to what extent. Post-crisis reform has also added some new functions for central banks. Firstly, 2/3 of the surveyed central banks had micro-prudential banking supervision residing within the central bank. Secondly, post-crisis, central banks gained more micro-prudential responsibilities for both banks and insurance companies, alongside new macro-prudential and resolution functions. And thirdly, yet insurance companies continue to be mostly supervised by separate supervisory agencies in 2/3 of the jurisdictions, which requires additional coordination. Significant changes in the institutional setup for consumer and investor protection has also taken place since the crisis. It is useful to reflect on how the focus on the conduct of business has interacted with prudential regulatory requirements. How have central banks managed with the additional responsibilities, separation of functions, and the practicalities involved in the coordination with supervisory agencies? This morning, we have assembled an impressive panel to reflect on whether we got the pieces of the structured supervisory architecture right. In the first part of this session, which will take about 25 minutes, And with the caliber of the panelists I have, I hope to save on that time. Over the life of the lifetime of the FSI, we have seen multiple changes in the supervisory architectures. Indeed, in some jurisdictions, we have come a full cycle to where we were decades ago. And in certain cases, with additional responsibilities to central banks. Let's explore the main lessons emerging from the crisis with respect to the organization of financial supervision. Firstly, has the case for direct involvement of central banks in financial supervision been strengthened? And secondly, has the recognition of financial stability objectives for central banks weakened arguments in favor of their independence? So we're going to start with you, Bill, and welcome back to Basel. And then we will move to Andrea, followed by Philip, Mario, and then Ignacio.
Obviously, I can't stay away. So I want to thank you, Chair, and thanks Fernando and Augustine for having this conference celebrating the FSI's 20th anniversary. This seems very well timed, given that two-decade period covers a considerable time before, during, and after the financial crisis. So as I see it, the financial crisis has strengthened the case for central bank involvement in bank supervision in several different ways. First, I think the crisis demonstrated the importance of central banks' lender of last resort authority. With respect to the Fed was very active during the crisis, lending to large banking organizations through the term auction facility, which auctioned off discount window credit. To major securities firms, there was a primary dealer credit facility. That latter facility effectively backstopped the tri-party repo market, which was a major source of funding for securities firms. Backstopping markets, the commercial paper funding facility and the term asset-backed securities loan facility, and in fact, backstopping the dollar funding market more broadly through the dollar swap network with other central banks. So clearly the lender last resort function is important, and I would argue if the Fed is going to be a potential lender, then it absolutely must have insight into the firms and markets that it might potentially lend to. So this is an argument for the Fed not being involved just in supervision of the major banking firms, but also that it have the ability to monitor the broad workings of the financial system, including the activities of non-banking firms that play important roles. Now, as you recall, during the financial crisis, it wasn't just banks that came under stress. In fact, other large securities firms came under stress even earlier. Bear Stearns, Lehman, and AIG played key roles in the crisis, and two out of those three firms were rescued. The problem was that their regulators, the SEC for Bear and Lehman, and AIG, the Office of Thrift Supervision, either did not have a financial stability orientation, I'd put the SEC in this boat, or did not have the expertise to oversee the systemic risk of the firms that they were supposed to supervise. The Office of Thrift Supervision did not have the ability to correctly assess the risk associated with AIG's financial products group. I suspect that the crisis would have been less severe if these firms had been better supervised. To do so, you would need regulators that had the authority to impose meaningful capital and liquidity requirements and to ensure good risk management and governance practices at these institutions, which I think were lacking. Second, the crisis demonstrated convincingly that the central banks must pay attention to the risks to financial stability. So put simply, without financial stability, monetary policy cannot be effective. The transmission mechanism of monetary policy, especially in the United States, to the real economy depends on a well-functioning financial system. That argues not only for a role in supervision by the central bank, but also a role in the oversight of the entire financial system. Now, if you recall in the legislative debate in the U.S. following the crisis, there were some that wanted to take away the Fed's supervisory function and move it to the Office of the Comptroller of the Currency and to the Federal Deposit Insurance Corporation. In the end, the argument that the Fed needed to have a major role in supervision, especially over the largest and most complex financial institutions, turned out to prevail. So not only did the Fed retain its role, but its role was also broadened to include the potential oversight of non-banking financial firms that the newly created Financial Stability Oversight Council deemed to be systemic. Now, unfortunately, with respect to this latter role, all the firms that were once deemed to be systemic by the FSOC have subsequently been de-designated. So, and the bar to designating a non-banking firm as systemic has been raised, partly due to the change in administrations, but also due to some legal rulings. So, in principle, the Fed could still oversee non-banking firms that are systemic, but whether that's actually going to happen in practice in a timely way in the future remains uncertain. So from my perspective, I think the Fed's role needs to go even further than this. As I see it, the central bank needs to monitor developments in the financial sector more generally. Speaking from my own experience as the head of the New York Fed, when I joined the markets group in 2007, the Fed was very much focused on just two sets of players: primary dealers, the major securities firms that underwrite and distribute the Treasury debt, and the banks that the New York Fed supervises. But there wasn't really much focus on the rest of the financial system. So one of my first decisions was to broaden out our monitoring function to include the so-called buy-side community. So that means have the markets desk and the senior manager of the bank focus on hedge funds, private equity firms, asset managers, and all the other important components of the financial system. This included ensuring that the advisory groups of the bank that advised the New York Fed included buy-side participants, which was very controversial at first. Sell-side people said that we can't have conversations with buy-side people on the committee. So we set up a subcommittee of buy-side firms, and eventually the sell-side firms realized that they could actually work with them. Now, some argue if a central bank were involved in supervision and ensuring financial stability, that this might compromise its independence with respect to the conduct of monetary policy. The notions is that the decisions in the supervisory space might create political repercussions that might motivate the executive branch or the legislative branch to constrain the central bank's independence. While one shouldn't be dismissive of this risk, I think this risk is not as significant as those who stress this argument. With respect to central bank independence, I think it's important to be clear what we mean here. In the United States, independence does not mean the Fed can just do whatever it wants in the areas in which it operates, be it monetary policy, supervision, or financial stability. The Fed is a creature of Congress and has to live within the structure established by Congress with regard to these areas. Where independence comes into play is not the Fed's objective or the toolkit the Fed has available to achieve those objectives. That's established by Congress. But instead it's in how it uses these tools tactically to achieve those objectives. The central bank needs to be held accountable against the outcomes it achieves or doesn't achieve. But within the scope of its powers, deference is appropriate with respect to the tactics that the central bank used to meet those objectives. In general, in the United States, with the exception of some of the president's recent tweets, I think that's where we are today. Independence in the conduct of monetary policy is pretty well enshrined for the simple reason that it has been demonstrated to lead to better economic outcomes. Thank you.
Well done, Bill. And Andrea?
Well, thanks a lot for having me here. First time since I started my new job here in Basel, so I'm very glad to be here. I would like to make a few remarks on the concept of independence. First, by starting to praise the introductory speech by Agustin Carstens on this topic. I think that the issue of independence of supervision has been to some extent a little bit, let's say, neglected also in the debate after the crisis. Also because, of course, we deployed a huge amount of taxpayers' money during the crisis, and this has led to, let's say, the greater scrutiny, greater interest of parliaments and the general public in general on how supervisory tasks are exercised. And I think in general this has, to some extent, strengthened the old argument, for instance, raised by Charles Goodhart some time ago, saying that he who pays the piper calls the tune. No? So that basically if eventually it is the government that has to put the money if something goes wrong, it is the government that needs to take responsibility also for supervision in good times. And it is to some extent, let's say, instructive the fact that when you look at the core principles of the Basel Committee, the point on independence strengthens the concept of operational independence. No, the idea is that you should independent in the operation of supervision, but in general there is a recognition that supervision is to some extent closer to broader public policy concerns. And we have to remember that when the core principles were developed, there were still several G10 countries in which supervision was actually allocated to finance ministries. So the independence was, that's also the background of having, you know, operational independence rather than a broader concept. Now, what has changed? Let's say the first point is that the G20 reforms clearly put a strong emphasis on the need to set up a framework for crisis management that prevents in the future huge, let's say, disbursement of taxpayers' money. So the idea that you need to have tools to manage the crisis also of systemically relevant institutions, no, in a smooth way, preparing for that and having ways of exit that are not detrimental to public budgets. Now, we are still not there, we have to be honest. We are still working to that objective, but if we believe that we are going to that direction, then the arguments that he who pays the piper chooses the tune becomes much less strong and could give a little bit more strength to the argument for independence. Also, let's say this point of lack of independence or constrained independence of supervision had been used in the past also by, let's say, prominent central bankers. I remember when I was at the ECB, Otmar Issing, for instance, was a strong supporter of this point, to say that bringing supervision and central banking together risks jeopardizing actually the independence of the central bank, because supervision is intrinsically, let's say, closer to political interest. So this point of, let's say, moving towards more, let's say, private resources to be used and to be first in line to take losses when crises materialize, in my view, weakens very much all the arguments that were used in the past for a separation between central banking and supervision. And the arguments for independence, I mean, I think Agustin said it very well, are basically the same that we use also for central banks. So timing consistency, there is indeed a strong incentive for politicians to, rely on the supervisory lever, economizing on the budgetary lever, to, for instance, support this or that sector of the economy. And I personally don't like, particularly when in the European debate I hear about supporting factors not to be used in let's say, make lighter the burden for this or that sector, and this has been used with reference to SMEs, infrastructure financing, green finance, mortgages, and the like. So, and there is this time inconsistency because you get the immediate advantage in terms of financing a sector of the economy, and when the risk materializes, probably the elections are already over, so the risks are longer term. There is also procyclicality of the political attitudes towards supervision. I mean, we have seen it at play in the aftermath of the crisis, big reaction, strong posturing on a need for very strong repair actions, then suddenly and very, very swiftly substituted by a more, let's say, lenient attitude with the idea of supporting the recovery. There is another aspect that I wanted to briefly touch upon on independence, which is not only the independence between, let's say, supervisors and politics, is the issue of independence between the supervisors and the supervised entity. So the issue of regulatory capture, I mean, Stigler's famous point. And here I think that also we have not reflected enough on the safeguards that are in place in terms of ensuring the necessary arm's length between the supervisory community and the supervised entities. I hear more and more, this argument that, I mean, there has been a strong argument in the past that I hear also now in terms of, having more expertise in the supervisory community coming directly from the market. I don't think we have addressed clearly enough the issue of revolving doors between supervisory authorities and industry. I think that the idea of gamer turn poach keeper is something that needs to be better discussed, because eventually it all boils down to people. I think if I look at the establishment of the ECB, let's say, as a supervisor, I think that the idea of having more arm's length also vis-à-vis national interests and national banks, taking more distance with respect to the banks at the time in which there was a clear need to strengthen supervision, has been a very important element. I would say a birthmark for ECB supervision to become and to be perceived as a very conservative, strong, and rigorous supervisor. And in this respect, I would like to close by saying how important I view the role of the Basel Committee on Banking Supervision, and to praise also the work of Stefan and in the last years in terms of ensuring that let's say, the work which is done here at in Basel is seen as a truly technical bulwark for supervisors that we could use and that the IMF in its scrutinies can also use in terms of strengthening the independence when the pressures on supervisors are getting strong. Thank you very much.
Thank you very much, Andrea. Philip?
Thank you, Chair, and happy birthday, Fernando, and it's great to be able to be here to celebrate with you. I come from a central bank that doesn't do bank supervision, and I'm completely happy with that. A separate supervisory agency was set up in 1998, so more than 20 years ago. I have not been making the case publicly that it should come back to the central bank, and we've had multiple inquiries into financial system regulation in Australia over recent times, and not any of those inquiries have recommended that it come back to the central bank. Our experience does suggest that different structures can work, and there isn't one size that fits everyone. I'd observe that there have been waves of fashion in this area. Once upon a time, supervision had to be with the central bank, then it shouldn't have been with the central bank, and now it should be with the central bank, and maybe we'll have another wave in the future, who knows. It's clear that different arrangements can work. It really depends upon the institutional structure, the culture in the country, and the structure of the financial system. One very clear benefit that I see of a standalone supervisor is that you have a CEO whose only job is to think about safety and soundness, not other things. As the governor of the central bank, you have a lot of things to think about. But if you have a standalone supervisor, every day the CEO gets up out of bed, he or she has got to think about safety and soundness. And that can bring a sharp organisational focus and help develop a strong culture in the organisation around safety and soundness. You can develop that same culture, obviously, within the central bank, but I think having a CEO who's that's their only job is a real benefit. The other benefit that I see is that the reputation of the central bank is protected from problems with micro-supervision. And I've seen this just recently in Australia, where as the inquiries that we've had, there's been quite a lot of criticism of the prudential regulator. And every time I hear the politicians speak or read the media, I'm very glad that that's not me. And the reputation of the central bank is it's important. And when there are problems at the supervisor, I'm very glad I'm not doing that. So, if in our case, if you're not the supervisor, then you have to have very strong coordination with the supervisor. And I'd observe that kind of around the world, supervisors have become very good at talking about culture in the institutions that they supervise. It's kind of one of the really growth industries, the culture of the institutions you supervise. In Australia, we're going down that same route as well, but we also talk a lot about the supervisory culture, and importantly, the culture of cooperation between the central bank, the supervisor, the securities regulator, and the Treasury. Because at the end of the day, all four organisations play an important role in financial stability. Some people like to say, well, assign financial stability to the central bank. But in reality, it's a job for the central bank, the supervisor, the securities regulator, the conduct regulator, and the Treasury, because they write the laws. So we spend a lot of time in Australia focusing on the culture of cooperation between the various entities. We largely do that through a group called the Council of Financial Regulators, which the Governor of the Central Bank chairs. We've agreed that wherever possible, we back one another publicly. We don't make negative comments about the other organisations in public if we can avoid it. The staff of our organisations are evaluated each year as part of their annual cycle on how they're building relationships with the other organisations. We establish multiple working groups so that the staff, at the staff level, they're kind of working closely with the other organisations. We don't have a macro-prudential regulator, and that's because we don't see it's a real distinction between micro-prudential regulation and macro-prudential regulation. If you're going to be a good micro-supervisor, you've got to have a macro focus. So we really see kind of, it's really the same thing. We don't really see a distinction, so you don't have a macro-prudential regulator. What we do, though, is the central bank discusses with the supervisor frequently what's going on in the macroeconomy and the system-wide risks. And in a couple of cases over recent years, out of those discussions, the supervisor has used its instruments to tighten up in a couple of areas, and that's really come from the dialogue with the central bank. The supervisor understands it's got to have a macro orientation. It partly draws that from the central bank, and we work cooperatively. As I said, we're not the supervisor, but we're one of the entities with a broad mandate for financial stability. We share that mandate. I don't worry that reduces our independence. We have some very clear responsibilities. As Bill said, the central bank's the lender of last resort, and we've agreed with APRA that if we had to make a lender of last resort loan, we would be relying on its assessment of the solvency of the organisation. We're the supervisor for the central counterparties. We're responsible for identifying system-wide risks. And we've also agreed with the government that in setting monetary policy, we can take account of financial stability issues. And over recent times, we've relied on that. Even though inflation was quite low, we decided not to cut interest rates because we thought that would just lead to even more borrowing in the system, and that would not be conducive to financial stability or the welfare of the society. So we've got broad responsibility for financial stability, but so do the other organisations we're dealing with, and so we have a very strong culture of cooperation. Thank you.
Thank you very much, Philip. Economists are not very good studying culture. It looks like we might still soon have to employ anthropologists in our institutions. But Mario.
Okay, thank you very much, Lizette, and thank you to the Financial Stability Institute for the invitation. Congratulations on the 20th anniversary. And we are very happy participating in many of the activities and initiatives that are promoted by the Institute. Now, given that I'm the only member of this panel that comes from an emerging country other than the chair, I think it's important in this discussion to highlight some of the features that may make emerging countries a little different from advanced countries relating to these issues. Usually, we see financial markets developing alongside the countries, so that means that financial markets are usually smaller in emerging countries. And that has two important meanings. First of all, usually economic crises in emerging countries do not originate in the financial sector in the way that they do in more advanced countries. It is true that the financial sector may be a very important amplifier of a crisis, but many times Crises originate either in the current account, originate on the side of fiscal policy or something else. Usually also misconceived exchange rate policy. Secondly, the second meaning of that, of having a smaller financial sector, is that financial deepening and financial widening or inclusiveness is an important challenge for development. So that means that public policy has to have an eye on how to help the financial sector to develop, and therefore issues related to the promotion of the financial sector are always around. Finally, in emerging countries, you usually have weaker public institutions and more concentrated financial sector, so the risk of capture of regulators is a very important risk. So those are the things that you have to deal with, and those create a number of trade-offs and dilemmas in banking supervision that you may imagine are important. In the case of Chile, the central bank has never been given full supervision authority over the financial sector. When the central bank was created in 1926, it was created at the same time as the banking supervisor. And actually, it was the same international mission that advised the Chilean government to create these two separate bodies. And they never merged, and we have lived alongside each other for more than 90 years. And the way in which we have interacted is basically through consultation or through integrating some ways of building cooperation or checks and balances through the procedures that we apply for different purposes. So the culture of cooperation that was mentioned earlier, I think, is part of our story. Now, given this background, the impact of the global financial crisis in Chile, like in other emerging countries, was a bit different. It is true, the Chilean economy went into a short-lived recession in 2009 that was related to a shortage of liquidity, especially with international banks that were operating in the country. Commodity markets plunged at that time, so that had an important impact on the economy, but they recovered very fast. And in the same way, the economy recovered very fast as well. So the central bank basically had to concentrate at that time on providing liquidity and, of course, manage monetary policy to cushion the impact of the financial crisis. But with the effect of with the experience of the crisis, we started issuing a financial stability report that is similar to financial stability reports everywhere. So in the next 8 years or so, as we deepened our ability to monitor financial markets and report on that through these mechanisms, we noted some constraints, some limitations, some issues that had been addressed that were a cause of concern earlier. And all of those led eventually to a reform of the banking law that was passed by Congress only a few months ago. This new banking law is making some important changes that have very much to do with the subject of our discussion today. First of all, they merged all the financial supervisors, so they merged the securities, insurance, and banking supervisor into one single entity. This is the Financial Markets Commission. Secondly, it moved from a single chief executive to a collegiate body that leads the organization, and this collegiate body is appointed very similarly to the central bank board. So the Financial Markets Commission is adopting some of the independence standards that the central bank has enjoyed since 1989. And third, it adopted the Basel III solvency standards with capital requirements, systemic charge, Pillar 2 requirements, and the countercyclical buffer. And it allocated responsibilities, assuming or taking into account the central bank responsibilities on financial stability and the Financial Markets Commission responsibilities on regulation of the financial industry. So the countercyclical buffer, the authority over the countercyclical buffer was given to the central bank. Authority over the systemic charge was given to the financial supervisor. But in both cases, procedure to activate and to set the parameters are a required consultation between both parties. Something that this new banking law doesn't do, and I think it's a challenge for the future, and it's part of the things that we need to work on in the future, is banking resolution. It only includes some sort of preventive mechanisms, but banking resolution as such is not there yet. So even though we live with this structure of a central bank with a mandate on financial stability and a banking regulator on a mandate on micro-prudential regulation, then with the creation of this new entity and those things change a little. Independence is strengthened in the level of the regulator, so now both bodies are independent, of course with some practical differences, and both are given some tools to discharge their responsibilities. Now, that is not the end of the story. Independence, in my experience, is not just ensuring that the politicians don't interfere with your decisions. Independence is, above all, a responsibility towards society. So independence comes with accountability, and the experience of the central bank is that that accountability is not just what is written into law, but something that you have to develop over time. So we have created a number of new mechanisms of accountability that didn't exist when the central bank was made independent. And my guess is that the Financial Markets Commission will have to do something pretty similar. Secondly, managing trade-offs is still important. Of course, it would be ideal to have entities that don't have any trade-off, that are very single-minded, have a very simple mandate, but that's not very common. And one way or another, you have to deal with trade-offs. So the thing here is, what is the nature of the trade-offs? What is worse? What is more complicated? A trade-off between price stability and financial stability, or a trade-off between market conduct and continuity of business in the banking sector. So from what I described, it's pretty clear the way in which those preferences have been reflected in policy or institutional decisions in the country. The final thing to mention is that we also have a financial stability board that has existed for a while. We can discuss that later in the panel, but that is an additional part of this architecture that has appeared in a number of countries, and I think it's interesting to discuss how effective this can be or not. Thank you.
Thanks, Mario. You've almost led us into the next session. Hopefully, we will make up for the time there. Ignacio, you can close the gate.
Thank you. Thank you very much. Thank you, Lesage. I did. Well, thank you for the invitation. Happy birthday. We are very glad to be part of this party. Let's see what I could add. First of all, I think that the issue of independence and the other issue of whether financial supervision, prudential supervision, and monetary policy mandates should be in a single house or not is dependent on a number of facts. Certainly cultural, institutional, historical, reputational. So I don't think that the idea that the simple justification that Philip gave of the single responsibility being what makes, say, for separating, because this way it is more effective and the less reputational costly for the central bank, possible failures in banking supervision is a principle that we should adhere to without trying to contradict it. And the contradiction goes through history. And history has to do also with the failures, the many failures that we have seen of a model in which the two entities did not cooperate, did not talk. Now, one issue is whether for making this easy, they should be under the single house, or whether they should somehow, we should envisage a way of having collaboration, cooperation, interaction in different forms. I think it depends very much on society, on the political system, on the institutional system. In our case, at the end, I think the reputational costs have been such that most has been put within the environment of central banking. Now, it has to be also seen that we are in a period of changes at the national level, but changes in Europe, especially at supranational levels. So we are having now responsibilities on monetary policy that are shared, and we have responsibilities on supervisory policies that are shared, and they are shared in among national competent authorities and the SSM, as far as supervision is concerned. They are shared with central bank governors in this case, but the institutions are very important, and the ECB for monetary policy. It seems to me that we should focus on what is new. And I think two things are new, as has been mentioned. Macro-prudential issues are relevant, and they are related with the kind of financial crisis that we have had. And then the other relevant change that we have been observing, certainly in Europe, but I think worldwide, mostly being discussed in the FSB, but also at the end producing changes from a rulemaking point of view, is clearly the resolution of banks in crisis, how to accompany in a smooth and orderly way the exit of banks from the market when a crisis cannot lead to a recovery of the bank. Now, in our case, I think that two things are clearly relevant. First, financial stability is part of the responsibility of the central bank. Even if it is not written with a red pen in the statute of a central bank or in the treaties that may somehow establish the principles, it is clear that if there is a crisis, at the end the central bank will be called in, and people will ask, where was the central bank when the financial instability started to be visible? We have a responsibility as central bankers. It is a macro issue for sure, and it is an issue that somehow has to be seen from this perspective. If price stability is the objective, we cannot maintain price stability if there is financial instability, both ways. That is, if we have excessive leverage, credit built up, and so on, even if you don't observe price instability, at the end, this will have will be visible and will have an effect. And vice versa, if you have somehow a deflationary risk, basically, at the end, if you don't use the monetary policy instruments, the risk is that you will end up in a financial instability situation. So the two are linked, and there are trade-offs and complementarities as far as the tools to deal with them are concerned. We have observed in the last 10 years or so substantial debate on whether we should use the tools monetary policy to deal with financial instability. Somehow the leaning against the wind. There has been obviously a lot of talks about the bluntness of using an interest rate to interfere or to enter into all the cracks of the financial system. But at the end, there is also a development, and I think a healthy development of discussion on how to better build macro-prudential instruments to deal with specific imbalances that perhaps may also be the result of using the blunt instrument that is the interest rate and unconventional tools, if you want, in this respect, to guarantee the price stability of the system. So this is one part. The other part is, however, that there is also the micro-prudential mandate in some central banks, and how that should be performed, what are the experience that we have with that from both the resolution of crisis and the financial stability at large. But I think here that we have to be more modest. There is certainly an importance as far as the systemic institutions have for financial stability. So I think that at the end, it is certainly very important the interaction between supervisors and those who are responsible for monetary policy. This interaction is easier within a central bank. Lending, last resort lending with collateral and at sufficiently high penalty rates is a well-known proposition. It is certainly easier, it has been easier to do that within the central banking because of information sharing, of the rapidity of interventions and so on. And this is, I think, something that was well known before the crisis, I think, has not been challenged, and as a matter of fact, has been reinforced by the crisis. The issue of micro-prudential and macro-prudential has to do with the procyclicality of interventions. And here there might be trade-offs. And the question is the following. Where should the trade-offs be solved? And I think that at the end, the solution of a trade-off is better to take place in a single institution. It is clear that there might be actions needed for the sake of the single institution, but we also have to understand that if the single institution is large and significant, this might have effects on the overall macroeconomy. And therefore, the interaction between these two, I think, can only take place at the single institution, the central bank level. We had experience of that. Where we differ now from the past is in the crisis solution. We have this new entity, which is in Europe, which is the resolution board, but it is something that is somehow visible in most jurisdictions. And the question here is how the governance of this institution should be organized. Again, there is an issue of exchange of information. there is no question that a resolution entity has to be informed about the conditions of the, I would say, the systemic institution that is under consideration for action from the supervisor, the micro-supervisor. The question here is on the speed and on the procedures that are followed. We also have in Europe national resolution authorities, and most of them are in the central banks. In that case, I think what we have done, but I think what is generally to be done, is to have Chinese walls to avoid really the interaction between those who supervise a bank and those who at the end are called for intervening in the resolution phase. There is one problem here which for us has been very important, and the problem is how to distinguish a bank that has to be solved, that is a resolution, put in resolution, which means using a number of instruments before eventually intervening with public funds. Think about various bail-in instruments which, independently from whether they've been well designed or not, clearly are to be used in order to ensure that the capital resources of the bank are in place in case of crisis, and what to do when instead a bank has to be put in liquidation, a piecemeal liquidation, which could be problematic for the provision of local services, but also for the smoothness of the solution of the crisis. Now, I think that still this is an issue on which we should work. I think that the way it has been approached in the United States has been, after the crisis, very interesting. We have the FDIC, which has been able really to liquidate a large number of small banks, I think various hundreds of banks, in an orderly way. In my case, from that, 4 very, very small banks have been put under the standard resolution regime with very costly effects. And this is something that has to do with proportionality, which has to do with information sharing, and which has to do with a final point which I like to deal with, which is consumer protection. I mean, much of the discussion which has taken place in these last years has been whether we should have a sectoral or a twin peak, if you want, or two agency, the slight difference between the two definitions, system of intervention in the financial market. Well, the sectoral has been, I think, is not anymore really the model that most are following. The twin peaks and the two agencies are interesting, especially if you think that basically you separate the stability issue from the consumer protection, the transparency issue. We have had a major problem, and this has had costs for the central bank reputation, and this is, in this sense, I think, I would stress where the separation should take place for the following reason. In our country, a number of banks had sold financial instruments, say, not only the shares of co-ops, cooperative banks, but subordinated debt at retail in a way that ex post may be considered, given the various transparency directives, MiFID and so on, as mis-selling. Now, why this has taken place? Because the Basel rules of Basel II were basically used by banks to provide an increase in total capital through the this availability of this subordinated debt. The problem is that if that was missold, and after the changes that have taken place at the European level on resolution, that is, and state aid, if you want, then what happens is that those who held that debt somehow risked to have it, to lose it, in the case of a resolution as well as in the case of piecemeal liquidation. Now, the issue here is very delicate because we have a problem in Italy as the central bank, as a supervisor, is responsible for the transparency up to banking instruments, deposits and loans, and the market authority is responsible for bonds, especially junior bonds, and the shares in the prospects that are provided to possible consumers, investors. Now, it is very difficult to identify responsibilities, to somehow put in place a system of exchange of information quick and effective and so on. And these risks to be exploited for political reasons. Now, obviously, we can, being independent, both on any side, there is a possibility to defend a position, a choice, and the intervention for the benefit of the society at large, but I think this is one of those issues that has not been sufficiently thought about. Thank you.
Thank you, Ignacio. I think that these were very useful insights. I must confess that the panel had actually gone into the next part of this session, which will make the next part of the session shorter than I thought it was going to be. But now I would like to take a poll of the audience. It's your chance to tell us how useful the panel was and get the perspectives from you. The question on the screen is as follows. Should central banks be responsible for financial supervision? Please select one of the following options. Only macro-prudential supervision, only micro-prudential supervision, both macro and micro supervision, or none of the above. So the poll is open. I actually do not believe that policy can be made through a show of hands in a crowded hall. But this is a very informed audience, so I shall trust your voting. Okay, 90. Shall we close the poll now and come back to the panelists? Let's see whether you have got different views after what the audience have said. Very quickly, let's start with you, Bill.
Okay, so I'm going to let the poll results speak for themselves. So I want to make 2 points. Regardless of what thinks whether a central bank should have a role with respect to macro-prudential supervision, the Fed really does not have much authority here. For example, the only explicit tool the Fed has is the countercyclical capital buffer, which the board can adjust for large banking organizations, and the Fed has never used it. A second point is, while the Fed also has some scope for supervisory guidance, here its authority has actually been trimmed back in recent years. And it's not even clear that this guidance can be used for macro-prudential concerns. If you may recall, a few years ago, the Fed issued guidance to its supervised institutions concerning leveraged lending. And subsequent to that guidance, the U.S. Government Accountability Office explicitly ruled that such guidance could be taken up and rescinded by Congress. This potential threat, I think, probably makes the Fed a little bit less inclined to use this sort of tool in the future. So in the U.S., it's not just a theoretical debate. Practically, the Fed has a very limited amount of tools, and even the tools it has, it looks like the restraints are quite significant. Thank you.
Andrea?
Well, I must say that the poll results have not affected my judgment that much. Let me rephrase what is my point. I mean, my point is that If the argument for separating is that supervision should be less independent, well, I would then reject that argument. But when supervision has sufficient guarantees of independence, I think that eventually the call of whether this should be under the same umbrella, micro-prudential supervision under the same umbrella of the central bank or not, is an open issue, and I personally favor having it under the central bank umbrella. But let's say I personally see the point raised by Philip that there could be alternative arrangements that work as well. And to be honest, during the crisis, we have seen both, let's say, arrangements work well or work less well. So there isn't a definitive evidence.
PC. Need to be bothered by all of this.
Well, I didn't vote because I couldn't work out which option to choose.
You are not part of the audience.
No, the question was should, and I don't think there is a right answer to that. I mean, different arrangements can work perfectly well, so it depends upon the history, the culture, and the institutional structure. So I don't think there is a right answer to that question. The other point I would make is I see the distinction between macro-prudential and micro-prudential as a false distinction. If you're going to be a good micro-supervisor, you need to understand the risks that are building up at the aggregate level in the financial system. And if you see those risks building up, then if you're a good micro-supervisor, you should be taking action, either more capital or restricting certain forms of lending. So in Australia, we don't make this distinction. The point is, if you're a good micro-supervisor, you have a macro orientation, and that, in our case, works with the central bank and the supervisor cooperating carefully.
Good. Mario, Ignacio?
Well, it seems to me that we were not very persuasive or very good role models, given that at least two of us are definitely not in the business of micro-supervision. I think that, as Ignacio said earlier, I think it's difficult to think of a central bank that is not does not do macro supervision in some way, because we are all lenders of last resort. Most of us have responsibilities in regulating liquidity, FX market, and so on. So to move there from to macro-prudential, I mean, there is a relatively short step, and if we don't take that, the risk that you run is that if you warn about financial risks and nothing happens, that may have a very negative consequence.
Thank you. Ignacio?
Yes, well,
very quickly.
I think that the poll was very clear, even if this is not an independent sample, I think, or perhaps it does not, it's not even representative, right? But macro-prudential, there is no question, as to be within the realms of central bank. Then the issue is the relation between macro-pru and micro-pru, and there are some things that are well known. I mean, the stress testing exercises can be efficiently done through the scenario analysis and so on, only if the two really are connected. And this is one thing that calls for having these two in a central bank environment. On the other hand, I repeat my main issue. And the main issue is whether the potential trade-offs that may materialize are better treated within the central bank or in a different way. If the different way is the political organizations of the country intervening, I think that we have to check whether this leads to a very suboptimal outcome. My a priori is that this is the case, and this is why for certain jurisdictions at least, it is better to have it within a single institution, the central bank.
Thanks, Ignacio. In a way, the panel had made it easy for me because they got into the second part of this session. because I now want to turn to the issue of mandates. Some supervisory agencies or past agencies are tasked with multiple mandates beyond providing protecting the interests of financial consumers and managing financial stability. For example, more and more supervisors are jumping onto the technology bandwagon, promoting fintech developments with sandboxes and send this and send that, and innovation hubs and competition in financial services and the lots. All these multiple objectives are competing with each other. Sometimes one would argue that they reinforce each other, but they then do pose a challenge for the various agencies. Let's change the order a bit. Bill, that is the problem you have with visiting us, because we will always start with you. But I'll go from you to Mario and then back to Ignacio. So, in the context of a rapidly evolving financial landscape, what supervisory capacity building initiatives are needed to shape the supervisors of tomorrow? So, Bill, Mario, and Ignacio.
Okay, so I have three broad capacity building initiatives that I would cite. First of all, I think cybersecurity risk is a key risk facing all financial institutions, so it's important that supervisors have the expertise to assess the cyber programs of the banks that they supervise. So are the programs broad enough, not just focusing on external threats, but also on insider threats? Are the programs focused on resiliency? If there is an intrusion, is there a well-defined program that governs how the institution will coordinate its response? Are the firm's technological and data architecture constructed in a way that's likely to limit the scope for damage? And does the institution have a good plan for recovery and for reaching out to its regulators and customers in a timely and thoughtful way, should there actually be a disruption? Second, I think it's really important to train supervisors to think systemically, that is, to consider threats to the financial system broadly. The financial crisis did not occur because of a single flaw in the financial system. There were very many. It's important in particular to understand how all the pieces fit together and how stress in one area may be transmitted and amplified elsewhere. In this regard, I think it's also important to address vulnerabilities that may not yet have actually manifested themselves in terms of poor outcomes. When I think about the financial crisis, there were a number of vulnerabilities that could have been addressed before the crisis actually occurred, but that was deferred. These include the U.S. money market mutual fund industry and the convention of the stable value of $1 per share, the tri-party repo system, the bilateral clearing of OTC derivatives, and so on and so on. Third, I think it's also important for supervisors to focus on business conduct risk and the incentive structure within the institutions that they supervise. Business conduct risk has literally cost the industry hundreds of billions of dollars in fines and penalties, and this conduct has undermined trust in the banking industry. We've seen bad behavior across a wide variety of areas: AML/BSA, manipulation of reference rates, questionable mortgage underwriting practices, and even the creation of phantom customer accounts. I think supervision could do more in this area. As I've said before, incentives drive behavior, and that behavior establishes the social norms that defines a firm's culture. That culture is very important to how a firm operates and the decisions that it makes when something may be legal but is of questionable behavior. This includes how customers are treated. Is it simply a policy of buyer beware, or is attention paid to ensure that what products and services are actually being provided to the customers are providing value to those customers? And how are employees treated when they raise their hands and identify troublesome issues? The willingness of people in an organization to speak up has important implications for whether little problems stay small because they're addressed promptly, or in contrast are ignored and repressed by senior management and become much more significant. How people are compensated and paid within the supervised firm is also important. I think less focus on cash and equity as a form of compensation might push the time horizon for bank executives further out and make better align risk reward within the institution more closely with the supervisory committee's goal of safety and soundness objectives. Thank you.
Thank you very much, Bill. Mario, this might, very briefly, this might just sound unfair because You said that this thing must be somewhere else and it is somewhere else, but your very brief comments on supervisory capability.
Sure. Well, I think that if we think of the main characteristics of the financial industry, first of all, we see that it's strongly interrelated. It is pretty innovative, and it has shown capacity to innovate over time. It affects the everyday lives of people everywhere, and it's global. It's increasingly global. So, in terms of capabilities, the ability to understand and interpret innovation, and innovation is increasingly connected with technology, is of course important. In our case, we have made technology one important component of our institutional strategy at the central bank, even though we are not in charge of banking supervision, but we need to understand what's going on in applying technology to the financial sector. In relation to interrelationships, we have been working on modeling modeling connections across the financial sector. Third, in terms of the relationship with clients, I think that we need to catch up on behavioral economics. And finally, I think that the global dimension is particularly important, because usually financial regulation is devised to operate within the boundaries of a country, but financial services are increasingly global, especially with the advent of technological innovation, and that's something that is, I think that regulators are still lagging behind. Thank you.
Thanks. Ignacio,
Yes.
You have a minute and a half.
Okay, the pace of change is extremely high, both technological, consumer preferences, the business models, and the regulation. I think that 4 issues have to be underlined. The first is that more and more the supervision has to move from supervising entities to supervising activities. So from banks or payment services to the actual loan industry or credit provision, payment provisions, and so on. And this somehow follows a trend that we are already in, the one of taking into account more and more what takes place in the shadow banking or non-bank financial intermediation, as now called. Second is risk oversight. Perhaps new approaches on risk oversight are necessary. We are engaged in more and more in SupTech kind of discussions, how to use artificial intelligence, machine learning, and so on, to put together new information, big data, and so on. We have a number in the bank. We have a number of results that underline the relation between liquidity risks, deposit runs, possible things, and the sentiment that you may collect from the social media and other information. The third is the ecosystem. I think the supervisors have more and more to collaborate with the ecosystem. It has to do with data sharing platforms. It has to do with approaches, whether innovation hubs or sandboxes. Again, we choose to have the innovation hub approach, at least at the very beginning, trying to familiarize and interact with the industry. Very successful. We have a so-called fintech channel, which is providing a lot of information, educating us, and in basically understanding what is where are the changes and what the reaction should be, and helping obviously the industry to behave. And the fourth point has to do, all these needs a reorganization of our supervisory activities, the organization in which you need to move perhaps from teams which are focused before on the entities, the large bank, the smaller banks, the asset managers, and so on, to the again to the activities with using technological skills that are not obviously available in the supervisory department, which have to be taken both from the market, but also have perhaps need on-job training, and so there is a lot of work on this. The competences are the usual one: economics, finance, governance, whatever. But more, we need also ability in dealing with data analysis and also perhaps relationship skills. And finally, adopting digital technology obviously needs that also the supervisor become more and more digital. This is a big challenge. Thank you.
Thank you very much, Ignacio. A minute each to Philip and Andrea. Could multiple mandates create potential conflicts with core supervisory objectives? I think that the panel have covered these things, but are there any particular things that at this stage that you would like to point out? Let's start with you, Philip.
Not from me. Not being a supervisor, I don't know how multiple mandates would conflict with kind of achieving any one of those. I think one issue that I do see is that many supervisors seem to be promoting kind of fintech, and I can understand why they want to understand the underlying issues, the cyber risks, the data protection risks, the potential for big tech firms to come in and reshape the financial landscape. So you've got to understand these issues, but I don't think supervisors should be promoters of these things, but they need to understand them.
Good. Andrea?
Well, in general, I would say that I prefer focused mandates. If we are pushing, as we said before, for independence and accountability, the more focused the mandate it is, the better. We have to acknowledge that safety and soundness is a pretty vague concept, and this generates some tensions at the boundaries. For instance, we are now in Europe grappling with this issue of anti-money laundering. I mean, of course, if a bank is involved in financial crime, in laundering money, it's difficult to say that it is a safe and sound bank, but we don't have, for instance, legal mandate to pursue these issues. So there is always a gray area which makes it difficult to focus the mandate. But there are a few points, 2 points I want to make. The first one is that the crisis clearly taught us that some type of mandates are potentially disruptive. If the supervisory authority is given a mandate to promote, for instance, local financial centers, I think that is not a good mandate. I mean, because generally, if you have the task of promoting the competitiveness, the international role of your center, you tend to pull your levers to actually relax standards in an unsafe and unsound way. On the issue of financial innovation, I mean, I very much agree with Philip that, let's say, I don't think supervisors should promote financial innovation. However, there is a thin line, and we shouldn't be seen as protecting rents of banks from competitive challenges from newcomers, and sometimes supervision is seen as a barrier to entry. So we need to make sure that this is not the case. And in general, my attitude is that we should always be risk focused. So if some entities is actually performing core banking activities, it should be supervised as a bank. We have recently, the ECB issued guidance on authorization for fintech banks. So if you are a fintech bank, you can be proportionate on how you authorize it. You can be, adjust a little bit the criteria to fit it, but you should still supervise as a bank. And if instead a fintech company is providing, payment services or challenging banks on specific aspects of the value chain, well, then you can be more relaxed, and you could be less comprehensive in your regulatory challenge. So all in all, in my view, you should always have a very strong risk-based rationale.
Thank you very much. I would now like to take another poll and get your perspectives. The question on your screen is, what should be the role of financial supervisors in relation to technological developments. It looks like our two speakers have just killed the idea. But please select one of the following options. One, contribute actively to orderly innovation. Second, focus only on implications on core supervisory objectives. And third, no specific role. Okay, I don't think any additional voting will change the result. So we'll close the poll here at 85. I think overwhelmingly that we should be focusing on implications on core supervisory objectives. Very quickly, 30 seconds. What regulatory blind spots does the panel see? Blind spots.
I would just say more focus on systemic, across the whole regime rather than doing, forest versus trees. A lot of detailed work in supervision where you do a lot of things that by tradition, by habit, and those things oftentimes don't actually add up to really good outcomes in terms of identifying systemic risk. So I think that's the challenge, is trying to train people to look much more broadly at the interactions across what's a very complex global financial system.
Good. Andrea?
Well, I think that now activities and risks have been unbundled and reallocated through a number of different players, and sometimes, as also Bill says, we lose sight of the overall risk. I think that there was a lot of attention on shadow banking at the beginning of the discussion. This has been faded away a bit. I think that probably the word in shadow banking was a bit misleading, but we still need to trace back risks much better than we're able to do right now.
Ignacio?
I want to talk about something totally different.
No, I don't want you to talk about something different. I want you to talk about regulatory blind spot.
Which has to do with the way we communicate.
Yeah.
And communication is one of the most difficult challenges that we are facing now. It is not understood what we do, and with the new media, there is a lot of information which is simply wrong, and we always play defense. So that is, I think, the main challenge that at least I have in front of me. Secondly, is politics. Obviously, we have to deal with politics. We are not independent from politics. We have to communicate with and perhaps educate the politicians, and we have to listen to what they have to say.
Politics will be so much fun if we didn't have politicians. Mario?
You may be quoted for that.
Yeah, I think that perhaps more than a blind spot, but a challenge. I think that this issue of moving to supervising entities to activities is, I think it's easier said than done. And I think that that's a major challenge that addresses also this issue of promotion and so on. I mean, the question the big question to me is whether we have the right approach to supervision, so as to be able to cover all the new activities that are developing, and I think that's a challenge that very few countries are undertaking yet.
Philip?
I don't know whether it's a blind spot or not, but I see a major challenge being to understand conduct issues. I mean, the supervisory community's got quite good at doing safety and soundness, capital liquidity, and all the great work that the Basel Committee has done. Do we really understand remuneration, internal culture, the incentives that exist within financial institutions, and how do we go about supervising or regulating those things? I think it's much more difficult than saying you've got to have X capital and Y liquidity. So understanding these issues I see as a major challenge.
Good, thank you very much. You have done very well that you could even find blind spots, because by definition you shouldn't see it if it is a blind spot. But you have done very well. But there appears to be broad convergence here that there isn't quite what is an ideal architecture for the organization of financial supervision. There isn't. What matters, though, seems to be that you have to have arrangements that facilitate information flows, adequate coordination across relevant agencies, and that, of course, incentives for responsible authorities. I will not attempt to summarize this very rich conversation. Suffice to say that you will still come back at 11:45, even if we ate a little bit into your coffee break. But once again, FSI, happy 20th anniversary, and thank you very much for the privilege of allowing me to chair this panel.